Welcome back here with us on Urban Debate on Mirror Now. So apart from making that statement on cryptocurrency, the RBI governor kept the key interest rates unchanged in its first policy meeting after the union budget this year. This was the 10th time in a row when rates remain unchanged. This means there will neither be any change in EMIs you pay nor on the interest rates that you earn for your deposits. In this era of uncertainty, RBI expects India's GDP to grow at 7.8% next year from 9.2% this year. RBI governor also mentioned that India is headed to become the fastest growing economy in the world. On inflation, he said we need to monitor crude prices going forward, and as per the current data, the retail inflation is going to be around 4.5% next year.
In India, real GDP growth at 9.2% for 21-22 takes it modestly above the level of GDP in 2019-20. Private consumption, the mainstay of domestic demand, continues to trail its pre-pandemic level. The persistent increase in international commodity prices, surge in volatility of global financial markets, and global supply bottlenecks can exacerbate risks to this outlook. If the last 2 years of living with the virus have taught us anything, it is to remain humble but grounded in self-belief, never losing confidence and optimism. As the great Lata Mangeshkar, whom we lost recently, sang in her immortal voice, "Aaj fir jeene ki tamanna hai." Together with the spirit behind the next line of this beautiful song, she has conveyed an eternal message of optimism. We in the Reserve Bank have remained steadfast in our commitment to safeguard trust and confidence in the domestic financial system as we rebuild the foundations of strong and sustainable growth with macroeconomic stability.
And joining us on the broadcast this evening is Saugata Bhattacharya, Chief Economist at Axis Bank, to help us understand what should we make of this policy announcement. Thank you for joining us on Mirror Now this evening. In your opinion, though it was the expectation of the economists, but why did the RBI keep the rates unchanged?
Thank you very much for this opportunity of interacting with your viewers, Heena. So my sense is that their own internal data and studies seem to suggest to them that demand is still not fully recovered. Obviously, it's not recovered. I mean, we are just going through the Omicron phase, the restrictions, etc. We are opening up, but we are still not there. So RBI calls this durable and broad-based demand. In other words, some of the higher income classes, households, are doing okay, but the lower and the middle income households, they are still feeling the impact of the slowdowns, the lockdowns, the restrictions, etc. So my guess is that because remember, raising their policy, the reverse repo or the repo, these technical terms, basically the RBI interest rate, that will have an impact across the board on various interest rates. I mean, home loan rates, car loan rates, other rates, corporate rates, MSME interest rates. So they didn't want to rock the boat at this point in time on various lending rates. Remember, if we can step back, the budget, the union budget had placed a lot of emphasis on particularly the MSMEs. The cost of lending to MSMEs, they had given these ECLGS, what they call ECLGS, credit support, etc. So my guess is that's the bottom line, that they, and in an environment that they consider still not fully recovered in terms of growth, they didn't want to disturb interest rates beyond a certain point.
But RBI is projecting 7.8% GDP growth next year, but Eco Survey's projection was about 8 to 8.5%. Is RBI being extra cautious or pragmatic?
So first, the 7.8% number, which is certainly, we at Axis Bank are at 8.3%. As you said, the economic survey is 8 to 8.5%, etc. So, but that 7.8% is consistent with their not doing anything on their interest rates. Because as we discussed, so they probably are sensing that there is still room for the system to grow. Growth is still not very durable. My own sense is there are pluses and minuses. I personally think it will be slightly higher in from the 7.8. But remember, one, the global economy is likely to slow down in 2022. The IMF has already come out with their forecast suggesting a slowdown in rates. China is slowing down very rapidly from about 8.1% last year to a forecast 4.8%. As a consequence of all of this, India has done very well last year in terms of exports. Exports have emerged to be a major growth engine, major source of growth. So given this, exports are probably not likely to do as well. That is to say, the growth of exports are not likely to do as well. So the onus on sustaining growth will be on consumption, will be on investment, which is where what you have seen the union, the central's budget do. But coming back again to that first narrative, that RBI probably feels that consumption demand has not recovered, and then governor actually said this, that we are pretty much at the same levels as the pre-pandemic levels. So my guess is they are giving this particular engine, consumption, a chance to drive growth and consumption. Because remember, in terms of bank credit, a large part of bank credit last year has gone to the household segment, the retail sector. So in terms of home loans, personal loans, etc. So again, I mean, it's circling back to the growth versus the interest rate story, and that's the growth segment that we are talking about.
How will you react to what RBI governor had to say on the issue of inflation? Are we underplaying it, or you feel it is under control? Because, on the ground, if you see, then things are getting expensive. Inflation is a reality.
Again, the 4.5% average CPI inflation that RBI forecast, we are slightly higher, 4.8%. Their view is that risks are there are some upside risk. It might be more than 4.5, it might be less than 4.5, depending on how food plays out. Our own sense is that with crude oil prices when touching $90 a barrel, I mean, it's come down a little bit, but $90 a barrel, and it's likely to stay above $80, $85 for many, many months. Given this, prices of aluminum have risen, nickel, copper, and because, I mean, there is some recovery in the developed markets, as a result of which the US Federal Reserve is looking to hike rates very aggressively. So my own sense is that unless the monsoons are once again, and this is the third or the fourth year in a row that we have had normal monsoons, very unusual. So unless the monsoons really behave badly, we will be somewhat protected from inflation. Because remember, with the slowdown of global growth, with China's slowdown, all these commodities, metals prices, etc., will come down. Crude remains a major issue. That given the uncertainties, geopolitical tensions, the lack of investment in oil recovery, etc., crude prices are likely to remain high, and these have a very direct impact into India. First, as energy prices, electricity prices, etc., which is the feedstock. Then coming into the transport sector, the costs of transporting various goods begins to increase. So my sense is we need to keep a very careful watch on inflation. If you were to ask people on the street, this sentiment would probably be that people feel that inflation might be a little higher than what is being projected by official numbers.
Now, for us, what matters is that rates have not been hiked. Means neither there'll be a change in our monthly EMIs nor in the deposit rates. There's one positive, one negative. But this status quo, of course, can't stay forever. How soon do you expect RBI to begin increasing rates, something that we are already witnessing, at least in the US?
You're absolutely right. However, deposit rates will be the first to move. You've already seen some banks beginning to raise deposit rates, particularly private sector banks. So I think from the lending side, from loans, the cost of borrowing, etc., that still remains a little bit away. But I think deposit rates are likely. It's not going to be a big move. 0.1%, 2%, 3%, etc. But slowly it will begin to begin to accelerate. From our point of view, RBI will probably start we were expecting that the reverse repo rate, which is, I mean, I don't want to get into technicalities, but some increase in the lower band of the rates will begin from April, likely. But the actual rates during which the loan rates will begin to move, that's probably way off into September or October of next year, this year, I mean, for the next fiscal year. So while loan rates have some way to go, deposit rates in the initial 3 to 6 months, that will begin to move up. Because first, the total amount of funds in the system, liquidity as it's called, that will begin to come down. And then at some point, the lower end of the repo of the policy rates, that will begin to move up, and that will push up the cost of funds for banks, where they will be looking for additional deposits.
You're telling us that positive news will come first and then the negative news will follow?
Well, negative news by that time, growth, spending power, disposable incomes will also begin to improve. So people will be able to absorb it. It's not going to be a very sharp move up in either deposit rates or loan rates.
All right, Mr. Saugata Bhattacharya, appreciate you joining us here on Mirror Now and helping us understand the key policy decision that was announced by the RBI governor today.